Hello, welcome to this short tutorial. We're going to be discussing on balance sheet, that is a financial position according to IS. So, balance sheet or financial position. Now, we are going to look at how we can look at this from the aspect of a layman and also from the aspect of a professional. So I want us to understand in a way that will be able to express it and also uh, give this information to a layman. Now we all know what an accounting equation is. The accounting equation, according to in accounting, is assets equals to capital plus liabilities. Now, if you have this at the back of your mind, you know this is a formula. And this formula is telling us that an asset is equal to capital plus liability. That is, an asset can be either fixed assets, that is non-current asset, or current asset. Part of the fixed asset we can have, let's say, according to IAS, we call them as PPE, property, plant, and equipment, where we have motor vehicle, we have plant and machinery, we have furnitures and fittings. This is a non-current. They can stay more than a year. You are using them to produce your normal operations, your normal business. If it is production, if it is service you are rendering, you need this particular asset to be able to work year in and year out so that you can be able to offer your deliverables. Now, this is called non-current or fixed asset. Now, the other one that is current asset. This is where we have inventory. We have account receivables. We have prepayment. That is advance payment. In a nutshell, these are your assets. If you still want to go ahead, we have intangible assets. These are tangible assets. The assets you can feel, you can touch, you can see. Intangible assets can be copyright, your patent rights, goodwill. I think mostly patent rights, copyright, right? Those are altogether fixed asset, that is non-current asset. Then these fall under the category of current asset. Now these are the assets, right? Now if you come to the equation, we have equal to capital. Capital is the money that's introduced by the owner or investors to start this business, to acquire this motor vehicle. Either they bring this capital. This capital mustn't be in cash form alone. The capital can also be in fixed asset form. You can bring in capital in form of your fixed asset. You can bring in capital in form of land. There's also land and building. You can also bring in your fixed asset in form of land and building function and fittings. It mustn't be cash, right? But in the case where you bring it in as cash, you can use that cash to also purchase this equipment and also purchase the inventories that you'll be using to carry out your transaction. Now, this came in as a result. This can come in as a result of your capital, right? Which is the same with equity. Now, in a business, maybe when you're just starting the business, it's possible. This is the equation. When you're just starting the business, it's possible your asset is equal to capital. Not in all forms that you have your asset equal to capital plus liability. Yes, if I'm just starting the business, I bring in 1 million from my own money and I acquire maybe one or two fixed assets. I also acquire some inventory and I start my business for the main time. At that particular moment, my accounting equation or my financial position or balance sheet will be showing as asset equal to capital. There is no room for liability, right? But in the case where I'm growing and trying to expand, maybe I already have a good supplier relation. I might decide that okay, I want to acquire some of these inventories on credit without paying. I don't want to pay now. I want to pay later. So it means you are using the resources, you are using the tools, you are using the resources from a vendor, from a third party to get this particular inventory. So it means this inventory is not coming from your equity alone. It's also coming from a liability. It's also coming from the loan. No, it can also come from loan. Yes, you can also get loan from a third party, maybe from a bank, and you want to use this loan to support yourself because you are trying to expand. This is also very, very important. So you now have that is the reason why you can now have a liability. So the liability also can come in the form of non-current and current, right? The non-current aspect, let's say you took a loan for that will mature for 5 years or 3 years or 2 years, more than a year. That is a long-term liability. It means this asset that you're having came to reality as a result of your equity and your liability. So if you bought this inventory on credit also, it means there is someone's resources, there is someone money in your own business, person money there inside your business. If I should come to the layman here, you use somebody kaya, they use run business. Normally, you cannot say that is your own resources, that is your own inventory. It's your inventory for sure, but you cannot claim ownership 100% because you have to pay back. There's an obligation for you to pay back that liability, right? That is in the case when you buy these goods on credit. You can in finance, we call it source of finance. The source of finance buying on credit. I can also decide that okay, I want to get loan from bank a huge amount of money because I want to carry out capital expenditure. I want to be able to buy motor vehicle. I want to be able to, because of mobility, I want to be able to deliver goods in different locations, different sites, different states. I want to also get plant and machinery. I want to have engine running because of mass production because they are demanding high of the goods I'm producing. I want to also get furniture and fittings to make my offices look fine, good, and I also have convenience, make it comfortable for staff and every other person to work in the land and building. Of course, if there's no land and there's no building, except you want to work on space. So most likely you have all this. You will need a huge amount of money to be able to acquire this fixed asset. But from your capital alone, from your equity alone, it might not be enough for you to use. Right? So in the case of you buying an inventory that is account payable, you have account payable opposite of account receivable. Account payable is you buying on credit. They also have accrued. Accrued. So you are supposed to pay for a particular rent. Let's say rent, for instance. You are already owing. You've already used the house, but you are yet to pay, or you've rented a particular equipment or any maybe tractor or any big equipment that you want to use, but you've used it beyond the time you've made payment for. So it's accrued. You have to pay back those periods you are using it in advance. So this is current. I'm just giving a very simple example. But the non-current is the bank loan. Of course, the bank loan has to be loan, not just short-term loan, not just 3 months, not just 2 months or 3 months or 6 months. It has to be 1 year and above. That's what makes it a non-current liability. Now, in a layman, if you let's look at Dangote. What financial position is telling you is that I want to know what Dangote has and what are the sources of what Dangote has. So this what Dangote has plenty. You can see all this truck going about, all this Dangote truck, plenty of the truck going about, right? There's Dangote cement, there's cement for instance. Now you can see all these Dangote truck coming, big truck. If you go to the factory, you see big machineries. You see plenty. Now in this case, is a listed that is listed. In this case, you have investors' money also, not just equity. Equity might not really be just you introducing the money. So in this time around, you are also introducing money, and other people because you are listed on an exchange. other people, other persons have the opportunity to also buy the shares of your company so that they will invest and also share in the dividend at the end of the year once you declare dividend. And if you declare loss, of course they will also share in that loss. Then not then this liability is there. Now Dangote, all the assets Dangote has, be it current or non-current assets, is as a result of equity and liability. That's the meaning of balance sheet. So balance sheet is telling us that the asset we are seeing in any business, let's even leave Dangote is still big. Your own business, your own smaller business you have at the side, you see that all the things you have might not really be from the money you invested. It might also be from the loan you took, or it might also be that you bought some inventories on credit and you have a plan to pay back. In addition to this, if you have a business and you also want to make use of this opportunity to I'm using this opportunity to also tell you that there are accounting softwares that you can also use to make sure that all these transactions you don't really bother yourself about where to post and where not to post. You just enter the transaction and the postings will be done automatically and you'll be able to understand what this particular thing. So there are accounting softwares, various type of accounting software. I also deal in those softwares also. If you are interested, you have a business and you don't know the value of your business, you don't know the value of your asset, you don't know the value of your equity or your liability, you can reach out to me and we'll also look at how we can collaborate together and ensure that you have your the valuation of your business, your financial position intact. Similarly, your assets can also be equal to liability. So let's say you are starting a business, but of course you don't have any money with you to start a business. So with the help of a bank or with the help of friends and family, you're able to accumulate that you're going to pay back. If you're not paying back, that is like a grant. So it's your equity. You are not paying anybody back, right? But then now that you are paying back, it means it's a liability. So uh, it can also be that your assets will be equal to liability. It mustn't be as a capital plus liability or just equity or capital. So assets can also be asset is equal to liabilities. This can also be the case, depend on the information, depend on the resources you have with you and how you acquire those resources. So it can also be asset is equal to liability. Now, looking at the general equity, which is capital plus liability. Now, I have an interesting notion here that both these two are all liabilities. In fact, your asset is equal to liability. Now, there is a distinction here to separate the identity of the owner from third party. So, in using business entity in accounting, you understand that a business is different from the owner. So now this asset you are seeing is the business. This is the business. This is under the business, right? You've acquired this fixed asset, you acquired this correct asset, and they are all existing under the name of the business. Then you introduce the money, you introduce an amount of money to be able to start this business, which the business is also owing you. That is why you are being paid dividend on the investment you've invested, or at the end of the day, you get your own shares, you get your own dividend, you get your own profit, you distribute the profit among shareholders, or you decide to reinvest the profit, ploughing back of profit. That's another source of finance apart from buying on credit that I mentioned earlier. Now, this is asset is equal to liability. The first liability here is the equity. The business is owing the owner an amount of money that the owner has invested plus any profit therein that might come in. Then the other liability, they are the third party liability, any other person apart from the owner. So asset is equal to liability, or you can classify asset is equal to equity plus liability, which are all liability because this now that is where you can see that the equity, if you are working with the T format, you can see that the equity and liability are always on a side, on one side. So you have equity and liability, then you have assets in this format. Or if you want to start with A vertical, I think assets, then equity, liability. This is total equity and liability. Then the other asset is total asset when you add the non-current asset and the current asset. So my point is your asset is equal to your liability, but the liability in the form of the ownership is the equity, and the other liability in the form of the third party is also a liability. So this is a broader way or a simpler way that we can understand what balance sheet. I'm using this balance sheet and financial position because of the interchangeability in the terminology. You can call it balance sheet or you call it financial position. All the same, the intent, the intention that this wants to represent is what we've discussed so far. If you have any question, don't forget to drop it on the comment section. Please like the video. You can also share the video to your group or any other person that is interested. And don't forget to follow me on YouTube so that you get and turn on notifications so you get notified whenever I make new videos.